Welcome to the deep dive. We're here to cut through the noise, get straight to what you need to know.
That's the goal.
Today, we are plunging into the very dynamic world of digital assets.
Right.
That includes everything, cryptocurrencies, the blockchain tech underneath it all, and that fascinating area of decentralized finance, or DeFi.
Yep, all of it.
And our mission is pretty clear.
Yeah.
Bring you some clarity on the current trends, spotlight who the key players are, and maybe most importantly, uncover those surprising real-world implications.
And the regulatory shifts, too, they're huge.
Absolutely. They're shaping the future of money, digital ownership. It's all happening now. So I guess the big question we're exploring is, are digital assets really ready for global mainstream adoption?
Or are the hurdles still too high? Security, regulation, perception.
Exactly. And to give you that comprehensive understanding, this deep dive pulls insights from, all over. We've got detailed industry reports.
Expert discussions from online communities, too. Some really sharp takes there.
And even official central bank documents. So it should give you the full picture.
Let's get into it then.
Okay, so let's unpack this. Where do we start? The market itself.
Yeah, let's look at the current market pulse. There's a definite vibrancy, especially around Ethereum right now.
Right. ETH is trading around, what, $3,000?
Around there, yeah. And lots of investors are looking towards $4,000, maybe even new all-time highs. It's got momentum.
And what's interesting for you listening is that it's not just crypto circles talking about it. We're seeing major financial news outlets.
Yeah.
CNBC, the New York Post.
They're practically shilling Ethereum, as the source puts it.
Yeah. Highlighting its, quote, practical use and calling tokenization its secret weapon. That feels like a real shift.
It is, especially when you compare it to Bitcoin. The conversation there is still often about it being a store of value.
Or, digital gold that can't be used to make anything and can't be worn as jewelry. A bit dismissive, maybe.
Perhaps, but it highlights the difference. Bitcoin is seen as digital gold, established in that role.
Whereas Ethereum?
Ethereum's utility is coming to the forefront. Powering applications, tokenizing real-world assets, art, real estate, you name it, putting ownership on the blockchain. That's a powerful narrative.
So it's the doing stuff aspect that's getting noticed now.
Exactly. And this fits into a bigger picture, that Gemini 2025 Global State of Crypto report. It shows crypto adoption is seriously picking up steam.
Especially with younger generations, right?
Absolutely. Globally, 50% of Gen Z and millennials own or have owned crypto. That's not niche anymore.
Wow, half. So crypto's becoming like a basic part of the financial toolkit for younger people.
It really signals a profound shift in how future wealth might be managed, yeah. It's moving beyond just early adopters.
That really puts it in perspective. And speaking of mainstream, what about ETFs? We're seeing a big jump in crypto ETF adoption in the U.S.
We are. Almost 2 in 5, 39% of crypto investors holding them in 2025. That's up from 37% just the year before, right after the spot ETFs got approved.
So that approval really opened the floodgates, or at least widened the channel significantly.
It provided a familiar, regulated way for people to get exposure.
Okay, but what about the other end of the spectrum? Meme coins. The sources say they're acting as an on-ramp.
Yeah, it's kind of surprising. In France, for instance, 67% of crypto investors own meme coins.
67%.
What?
Wow. So these seemingly silly coins are actually drawing people in. What's that about? Investment psychology.
I think it tells us that accessibility and, viral appeal are powerful forces.
Lower price points, maybe. Strong communities.
Exactly. They feel less intimidating than, say, trying to understand complex DeFi protocols right off the bat. People learn the basics of buying, selling, holding.
Even if the coin itself doesn't do much.
Right. But that ease of entry, it definitely comes with risks, big risks.
Which brings us to security.
Yeah.
The market might be vibrant, but there are serious challenges.
Absolutely. Look at that GMX V1 vulnerability mentioned in the sources.
Right, the code base issue. How much was at risk?
$42 million was secured, thankfully. And they paid out a $5 million bounty for the recovery.
$5 million. That's huge. But it's a stark reminder, isn't it? The threats are very real.
Very real. And incidents like that, they don't exactly build confidence, do they?
No. What does something like GMX tell us about security audits and risk management in DeFi right now? Is it keeping pace?
It underlines the critical need for constant vigilance, for robust auditing. Bounties help recover funds, sure, but preventing these in the first place is key. These events erode trust.
And restoring that trust seems paramount.
It is. The PwC 2024 Outlook report nails it. Regulatory frameworks are seen as crucial now for building a thriving ecosystem. People want clear rules.
Makes sense. Which leads us to the global quest for clarity. We have these big standard-setting bodies involved.
Right, like the Financial Action Task Force, FATF.
And they seem pretty concerned. They're flagging serious issues with anti-money laundering and counter-terrorist financing standards not being implemented.
Yeah, their assessment of 98 jurisdictions found 75% are only partially compliant or non-compliant. That's not good.
75%. And over half haven't even put the travel rule in place for crypto transactions.
Still haven't, yeah. That rule is crucial. It requires sharing customer info for transactions over a certain amount.
So without widespread compliance, especially on the travel rule, what are the actual consequences? It sounds like a gaping hole.
It is a critical vulnerability. It means illicit crypto flows can move much more easily in many parts of the world. It's fertile ground for financial crime, and that undermines the whole system's legitimacy.
Okay, so FATF is focused on the financial crime aspect. What about investor protection?
That's where IOSCO comes in, the International Organization of Securities Commissions. They're pushing recommendations for investor protection, market integrity.
Trying to align crypto regulation with traditional finance.
Essentially, yes, calling for similar outcomes and stressing the need for cross-border cooperation because crypto doesn't respect borders.
And then there's the banking side, the Basel Committee, BCBS.
Right. They've set a deadline, January 2025. Banks holding unbacked crypto assets or stablecoins with shaky stabilization mechanisms will face conservative prudential treatment.
Which basically means?
It means they'll have to hold a lot more capital against those assets, making them less attractive, effectively capping exposure to riskier crypto at around 2% of their total.
Okay, so global bodies are setting these high-level standards.
Yeah.
How does that translate on the ground? The regional approaches seem pretty diverse.
Hugely diverse. Look at the EU with MiCAR, the markets in crypto assets regulation.
That's a big one, right? The first cross-border framework.
It is. It came into force July 2023, replacing that patchwork of national rules.
Yeah.
Stablecoin rules are coming mid-2024, other parts by December 2024.
And MiCAR has some specific prohibitions, too. Something about yield on certain currencies.
Yeah, it prohibits yield and interest on EMTs, electronic money tokens. Those are basically stablecoins meant to mimic digital cash.
Why ban yield on those? What's the thinking?
The idea is likely to prevent the kind of speculative risks we saw with some high-yield crypto products, treating these more like regulated traditional money, not investment vehicles. Keep them stable, focused on payments.
Interesting. So the EU is forging ahead with a comprehensive plan. How does the U.S. compare? The sources call it an outlier.
It really is an outlier among its peers. The regulatory system is complex, fragmented, different agencies vying for control.
And we saw President Trump's executive order in 2025 specifically halting work on a retail CBDC.
Yeah, the U.S. became the only country to formally do that, though there are other efforts moving forward, like the Clarity for Payment Stablecoins Act.
What's the goal there?
Trying to classify payment stablecoins as not securities. That would provide a clearer path, potentially under banking regulators rather than the SEC, but it's still debated.
So this U.S. fragmentation, it creates an opening, doesn't it, for other regions?
Absolutely. We're seeing Asia and the Middle East really stepping up, positioning themselves as hubs.
Like Hong Kong SAR, aiming to be a global hub for virtual assets.
Exactly, proposing its own stablecoin licensing regime. And the UAE has similar ambitions. Dubai's Viara, Abu Dhabi's ADGM, putting comprehensive frameworks in place.
And South Korea's influence is growing too, hosting Korea Blockchain Week.
Yeah, leveraging its strong gaming industry and developer talent, they see an opportunity.
So for a business operating in this space, navigating all these different rules,
Yeah.
It must be tricky.
It creates huge complexities. Costs go up. You need legal teams monitoring regulations in every market.
And that's why we see places like Switzerland, Singapore, Hong Kong, Malta becoming magnets for talent.
Precisely. Jurisdictions with clearer, more supportive frameworks are attracting the businesses and the people driving innovation. Regulatory clarity is a competitive advantage now.
It directly influences where innovation happens in the real world. Okay, so regulation is shaping the landscape. Let's shift to how digital assets are actually being used, starting with the big one, national money itself.
Central Bank Digital Currencies, CBDCs.
The numbers here are kind of staggering. How many countries are actually looking into this?
Get this. 137 countries and currency unions. That represents 98% of global GDP.
98%. So basically everyone is exploring a CBDC.
Pretty much. And 49 pilot projects are already underway. It's moved way beyond theoretical discussions.
So why? What's driving this massive global push? What are the real-world motivations?
They're pretty diverse, actually. Reducing reliance on physical cash is one. Enhancing financial inclusion, getting digital payments to people without bank accounts.
Making payments more efficient, lowering costs.
Exactly. And improving transparency and money flows for governments and central banks. But one of the really fascinating drivers is this idea of programmable money.
Programmable money, what does that mean in practice?
Imagine money that comes with built-in rules, like government aid that can only be spent on specific things like food or housing, or a payment that only gets released once a contract condition is met automatically.
Okay, that opens up a lot of possibilities. For efficiency, but maybe also control.
Both, potentially. It's a powerful concept, and it's not just theoretical. We have live example.
Right, like the Bahamas. Their sand dollar was one of the first.
Launched back in 2020, Jamaica and Nigeria also have fully launched CBDCs.
And major economies are piloting them too.
Oh, yeah. The European Central Bank is deep into piloting the digital euro. The People's Bank of China is actively promoting the digital yuan, partly to boost its international role.
And they're collaborating across borders too.
Definitely. There's been a jump in cross-border wholesale CBDC projects, bank-to-bank stuff. 13 projects now.
Like Project Agora, with the U.S. and other central banks.
Yep. And Project Enbridge, connecting banks in China, Thailand, UAE, Hong Kong, Saudi Arabia. They're testing how CBDCs could make international payments faster and cheaper.
So a huge amount of activity from central banks. But innovation is also happening outside the official sector, in DeFi.
Absolutely. Decentralized finance is expanding rapidly. Take something like 1inch Network.
What do they do?
Founded in 2019, it's basically a data aggregator for DeFi. It scans decentralized exchanges, DEXs, to find you the best possible prices for your crypto trades.
How does it do that?
It uses a protocol called Pathfinder. It compares prices, fees, even slippage across multiple exchanges to find the most efficient route for your transaction. The difference can be, as the source says, jaw-dropping.
So it's optimizing transactions in real time.
Making DeFi more efficient for the end user, yeah.
And they're bridging this to the traditional world too. I saw a mention of a debit card.
Yeah, they partnered with MasterCard and Binance back in April 2024 to roll out a Web3 debit card. Lets you spend your crypto more easily.
And expanding onto other blockchains like Solana.
Right, that happened April 2025. Shows they're pushing for broader integration, reaching more users.
Looking further out in DeFi, this idea of under-collateralized loans keeps coming up. That sounds counterintuitive for lending. How would that work?
It's definitely pushing the boundaries. The core idea relies on things like Sybil resistance, preventing fake identities, plus on-chain reputation and trust systems.
So your past blockchain activity could act as a form of collateral, almost, without needing traditional KYC.
That's the concept. Building creditworthiness based on verifiable on-chain behavior and reputation. It's still early days, but it's a fascinating direction.
And how might AI play into this? The sources mention AI and crypto potentially streamlining things.
Well, imagine using AI to analyze that on-chain data for credit scoring. Combine that with NFTs for identity or maybe even proof of asset ownership.
And ZK proofs for privacy.
Exactly. Zero-knowledge proof, running on rails like Ethereum. The potential is there to streamline a lot of the paperwork verification steps for loans.
Even potentially things like mortgages, using crypto as a deposit.
That's the kind of blue sky thinking happening. It would be a massive real-world shift, obviously, with lots of hurdles, but the tech opens the door to exploring it.
Okay, one more area where digital assets are making waves and causing arguments. Blockchain gaming.
Ah, yes, play to earn.
The idea is integrating digital asset ownership, usually NFTs, into games, right? Players truly own their items.
That's the promise. We've seen big names like Axie Infinity, CryptoKitties, and newer ones like a Flappy Bird type game, MapleStory Universe.
Sounds like a natural fit for gaming, giving players real ownership. But the reception hasn't been universally positive.
Far from it. It's been really mixed, quite controversial actually. You have publishers like Square Enix who are hopeful, thinking NFTs could be a major trend.
But then others are pushing back hard.
Oh yeah, Steam banned blockchain games entirely. The indie store itch.io flat out called NFTs a scam.
Wow. And didn't STALKER2 have to cancel NFT plans because of backlash?
They did. And you hear these criticisms comparing play-to-earn models to pyramid schemes or Ponzi's. Even the head of Xbox said he's wary of exploitive NFT gaming projects.
So a lot of excitement, but also serious concerns about the models being used. Growing pains, I guess.
Definitely growing pains. There's tension between the innovative potential and concerns about exploitation or unsustainable economics. It's still very much evolving.
Okay. Well, I think that brings us towards the end of this deep dive. We've really covered a lot of ground.
We have, from the market buzz around Ethereum to the global regulatory scramble to these diverse real-world applications.
Central banks building digital currencies, DeFi trying to optimize finance, gaming exploring new ownership models. It's complex.
For sure.
We kind of set out asking if digital assets are ready for the mainstream, and I think the answer is it's complicated. The journey is definitely ongoing, huge promise, but also significant hurdles still.
Absolutely. And as we think about all this, it's not just about the tech itself, is it? It's about how it could fundamentally reshape things we do every day. Banking, payments, entertainment, even how we define owning something in the digital world.
That leads nicely into a final thought for you, the listener. Thinking about all these changes, what's one area of your life you think will be most profoundly impacted by digital assets in the next, say, 5 years? And why? Something to mull over.
It's a good question to leave people with.
Indeed. Well, thank you for joining us on this deep dive. We hope it gave you some clarity and things to think about.
Keep exploring. Stay curious.
Thanks for listening.